Hello traders, the title of this video is Know Why Fibonacci Traders Miss High Probability Trades. Alright, so are you a Fibonacci trader? Have you been missing a lot of high probability trading setup? Alright, today we want to talk about why do Fibonacci traders miss high probability trades. Alright. So, you are a Fibonacci trader, you use Fibonacci retracements, you use Fibonacci extension, you know also about the sweet spot zone, alright, but you want to make successful a trade with the Fibonacci. I remember the first time that I learned about the Fibonacci, and I go around on the chart and I place my Fibonacci retracement, and price pull back to 38.2%, I buy, price continue to go down, I lose money, price pull back to 50%, I try to buy, and it didn't work, and then I know about the sweet spot zone, price came to the sweet spot zone, after going up, and I buy, and it didn't work, and I'm wondering, this thing is not working. Then my final conclusion was that the Fibonacci retracement, Fibonacci extension levels are just key levels. All right, they are just highlighting a key level. Then I went a little bit further to understand, okay, what this mumbo jumbo about Fibonacci is all about, okay. Then I try to simplify it because that's the way my mind functions. So I say, all right, so if the price, okay, goes out from A to B, if it pull backs, okay, to 38.2%, that's my own interpretation, to 38.2%, it means that we have a kind of discount of 1/3 of, call it 33%, 1/3 of, okay? So I say, okay, if it come down to 50%, that's 50% discount, so to speak. If it come down to 78.6%, call it 75%, okay, discount. So then I try to say, I say, all right, so stock going up, okay, and then it pull back, it becomes cheap. All right, then people want to buy because something that was £100 is now £75. Something that is $100 is now $50. Something that is $100 is now $25. And I see the Fibonacci retracement that giving me, okay, a quick, okay, idea where we are, whether we have a discount or not. Then I'm thinking, all right, so if I'm on a 3-minute time frame and I have a 50% discount, is that 50% of the price? So the 50% retracement on the 3-minute time frame is not the 50% of the 50-minute time frame on the daily chart, on the weekly chart. Then I start thinking, what's going on? Which 50% should I choose? Should I choose the 50% on the 3-minute time frame, the daily chart, the monthly chart, or any higher time frame? So after a while, I get a bit confused and I'm saying, well, what should I do? I realized that, in fact, my problem was that I was trying to trade Fibonacci instead of trading the price. This is one of the reasons why a lot of Fibonacci traders miss, okay, high probability trading. They are trading the 38.2% retracement or the Fibonacci retracement. They are trading Fibonacci extension level instead of trading the price. Okay, so let's look at this chart now. We are on a monthly chart, which I like very much. And we are looking at financial instrument called Coach Incorporation, EPIC, COH. All right, so now you can see that price start going up. So we are here. So let's put a spot there. Price start going up, okay? Going up. So it's not very clear here. So it went up to this point. And then it pulled back a bit. You see here, it pulled back a bit, and then start going up. Price went up to this point, and then it pulled back a bit, and then start going up. But you see, though another reason why Fibonacci traders are missing trading opportunity is that they forget that not all traders use the Fibonacci retracement or extension the same way. So as you can see on this chart now, the way I place my Fibonacci retracement, I draw it from here to here. And so now this pullback didn't even reach the 38.2% level. Other traders may not draw it that way on their chart. All right? So they may just go and say, George, I'm only focusing on a recent price move on my monthly chart. So you see these two. So there was a bit of a bearish candlestick here. And then we have two candlestick bar up, and then it pulled back to the 50% level. It's not very clear on my chart because I had a bit of problem to zoom into it on the left-hand side. So this is one of the reasons, okay, why Fibonacci traders are missing trading opportunity, because you have to understand how other traders are also using the Fibonacci retracement. I may put mine like this, but another trader may say, okay, I'll put it here. So from after that bearish candlestick bar, two candlestick bar out, and those pull back, that's how I'm going to use my Fibonacci retracement. All right. So first factor, Fibonacci traders are trading the Fibonacci retracement, Fibonacci extension instead of the price. Second factor is Fibonacci traders, okay, do not pay attention to other Fibonacci traders to know what's happening. All right. Okay, now let's continue. Suppose I still leave my line there. And now we are here. Price pull back to 38.2% level right here. Okay. Another thing, another reason why the Fibonacci traders are missing high probability trading setup is because they forget basic technical analysis. What do I mean by basic technical analysis? Okay, I'll tell you in a minute. Basic technical analysis is very simple. Is this, and it's also powerful. And you will maybe go to a professional trader, they will tell you break a bull, retest, turn around. For bullish trading setup, this is the basic bullish trading setup. The basic bearish trading setup. So if somebody asks you, teach me how to trade, this is why you should tell the person straight away. You are trading a price, and there are two trading setups. Here they are, break below, retest, turn around. So a Fibonacci trader, okay, a Fibonacci trader will quickly improve Fibonacci trading result if he or she combines, okay, the Fibonacci retracement, Fibonacci extensions with the basic technical analysis. All right. So what I'm going to do now, hold on please. I'm writing something down for myself. So here you can see that why the price did went up here, did go up here. So here we are. So you can see my Fibonacci retracement price went up all the way up here and then pulled back. Before that, there was a resistance here, the price from a high here. You can see that it slowed down. So here it pulled back a bit and went up a bit, pulled back a bit, went up a bit, and then break above that key level on a monthly chart. So this was a high, that was a resistance. In fact, the price was coming near that resistance. So what has happened here, it breaks above that resistance level and pull back to retest it. So now, if one is combining the Fibonacci retracement with basic technical analysis, which means breaks above, retest, turn around, one will make a better Fibonacci retracement trading decision, even a Fibonacci extension trading decision. Will you promise me that from today, you don't have to promise me anything, all right? Will you promise me from today that you will start combining the Fibonacci trading with basic technical analysis? Break above, retest, turn around, break below, retest, turn around. So you will be combining your Fibonacci retracement with a key level that corresponds to a key level, breaks above, retest, turn around, and then after that, you will implement a top-down trading method. There are other mistakes that can lead the Fibonacci trader to miss high probability trading setup. In fact, the basic technical analysis will highlight, okay, high probability trading setup, break above, retest, turn around. There is another factor that also lead the Fibonacci traders to miss a high probability trading setups. Which one? Which one? The market pattern. So for that, I will recommend to trader to go to www.theprotrader.com and to click on how to trade Fibonacci webpage. All right, the market pattern. All right, the market pattern. So I'm going to start. There are 3 market patterns: rising channel, declining channel, horizontal channel. And here we are. We start drawing channels. So draw my channel like this. This point and this point allow me to draw the first line. I choose this point, I draw another line that is parallel to the first line. So as you can see, so price came down 1, 2, 3. All right. There are other Fibonacci trading videos at dayprotrader.com that you can watch. All right. So you see here. So now let's apply Fibonacci retracement, and I will highlight the mistake that is happening here. So now I apply my Fibonacci like this all the way up here, and you can see that here we are now here. Pay attention. The price retesting which level? The 50% Fibonacci retracement level. But look at the market pattern. What is happening here? The price break below the rising channel. So is it a good place to buy? It did go up a bit. If you are aware that it should go up a bit, this is just the price was trying to retest that channel, which bringing us back to the basic technical analysis. Break below. So here it retesting the 50% after breaking below the channel. Now, boom, it stopped there. So normally you will say, all right, it's a tricky place to buy. I will decide to day trade. So you day trade all this month, gently come near, you come out. But if you just assume that, okay, it's now in a sweet spot, it's now, no, not in a sweet spot zone, it's now between the 38.2% and the 50% Fibonacci retracement zone. It's a good place to buy, has been going up for some time, it's now 50% level. And even some experienced traders always buy at 50% level. There are trading software out there, trading robots out there that are always buying at the 50% Fibonacci retracement level. But now, as you can see, now we are paying attention to the market pattern. We will, if you are aware of the market pattern, you will be a little bit careful. Yes or no? Another thing I will say to you, here it is. You can see that if you connect this point and this one here, we have a bearish trend line. We have a bearish trend line. So price start coming down, failed to form a new lower low in comparison to this low here, form a double bottom, which is good, but we are below that channel. So if we are buying here, we can use day trading and be very, very careful. Wait for it to break above, okay, the lower part of the channel, because we know that there will be other traders trying to sell it as the price is retesting the channel. All right. So those are just factors, reasons why Fibonacci traders miss high probability trading setup. Another reason why Fibonacci traders miss high probability trade is because they are aggressive. Now, I'm choosing my word carefully. They are not individual that in real life are aggressive. We are talking about the way they trade, all right? They are not going around, okay, hurting people, but when they are trading, they are rushing quickly, all right? Price at 38.2%, they buy. They just react, okay? That's what I meant by being aggressive. They are not patient. They are not composed. They behave like, all right, somebody who is trading for the first time, all right? So you'll see there are many trading software out there that are using Fibonacci, and those trading software are distorting the market. They are just rushing, boom, buy, sell, because price at the Fibonacci level, we have Fibonacci cluster, Fibonacci extension level, and they are just buying, reacting, instead of waiting for a setup, instead of waiting for a high probability to set out, break a bow, retest, implement a top-down to the middle, break below, retest, implement a top-down to the middle in conjunction with the Fibonacci retracement and Fibonacci, okay, extension. I have one more chart I want to show you very fast. Let's see how long I'll be talking to you. I want to keep this one very short. 40 minutes, very short. So here we are looking at another financial instrument, CHUY. Wow, that's difficult name. The epic is CHUY. That's another American stock, Charlie Hotel Uniform Yankee. And one more time, let's try to apply the Fibonacci retracement. Okay, here it is. So if you like, we put it here first. So it came down here, start coming down. It came down to the 50% level. All right. So you see, price is at a key level, 50% of the first move. You just say it's at a key level. All right. What do you need to do? Remember that you must trade the price. Because one of the reasons why they are missing an opportunity is because they are, all right, trading Fibonacci instead of the price. So attention to the price. So price running up and then it pulled back to the 50% level. If, for instance, you're on from the monthly chart, if you're on a monthly chart, quarterly chart, yearly chart, remember that the closing price, the opening price, the high and the low of each candlestick bar are also key levels. So here we don't have any resistance on our left hand side, so we can use the high, the low, and the median line, the opening price of the candlestick bar here. You can see that what has happened here, you see this candle here, this candlestick bar here, the price breaks above that the high of that candlestick bar and pull back to retest that high. Can you see? I'm talking about this candlestick bar here. So if you're on a monthly chart, quarterly chart, yearly chart, remember the high, the low, and the median line of each candlestick bar are key levels. So if you do not see a proper key level, as we did in the previous chart, use the high, the low, and the median line. So here the price breaks above the high of this candlestick bar. Professionals know that this level is the key level, this is the high of this particular amount. So it breaks above and now is retesting its basic technical analysis in conjunction with the Fibonacci retracement. But now, what's the next step? Use different time frame to trade it. Monthly chart, daily chart, hourly time frame, or 4-hour time frame, 50-minute time frame, 3-minute time frame, daily chart, hourly time frame, 10-minute time frame. Use different time frame, okay? All right? All right? So if we push it all the way up here, then it pull back again to the 38.2% level, which is almost corresponding to the high of this candlestick bar. You see there was a doji here, but another thing which I talked about before is to look at how the price came down. So I talked about this before. I will just mention it now. The price structure, the pullback that we are looking for normally should be in three. See sometimes like 1, 2, 3 to a key level. Break a ball, retest, basic technical analysis. Price coming down 1, 2, 3. Now we implement a top-down trading method to trade it. Again, you don't want to forget the market pattern, and you don't want to violate the market pattern. Sometimes you will have, I haven't seen one example clearly I can show you here. So what do I mean? So you will see, let's give one example by my drawing, okay? Okay, so you see now, price going up like this, okay? Went up, okay? I want to wrap it now. I'm under time pressure, price goes up. Okay, and then it went up again, display a new high, okay, somewhere here, like this, and then it pulled back to retest. Okay, so what I'll do, sorry traders. So there was a low here, then we have a higher low, then we draw this line here, and then we choose this point to make a line that is parallel to the first line. So with this point and this point, we have the first line. Now the price pull back to the second time to retest that channel on the edge. All right. Then you apply your Fibonacci retracement either to this session from here to here or from the beginning. So price retesting the edge of the channel and also corresponding to a key Fibonacci retracement level. That will be another high probability trading setup, but we must trade it with a top-down trading method. All right. So those are the factors that cause Fibonacci traders to miss a high probability trading setup. They are trading the Fibonacci retracement, Fibonacci extension instead of the price. Do not do that. Okay. They do not pay attention to other Fibonacci traders, which means other Fibonacci traders may not draw it from the beginning. They may pay attention to few candlestick bar. So be aware of those Fibonacci traders. And so you may go into their mind. So you may try to see what's going on. Sometimes the best example is when the price is not. So you draw your Fibonacci retracement, all right, and you see the pullback is not even touching the 38.2% level. You must now check if there is another way you can place your Fibonacci retracement on your chart. All right, so trade the price action, pay attention to other Fibonacci traders. All right, the third cause is that Fibonacci traders are not using the basic technical analysis: breakable, retested down, break below, retested down. If you start from today using your Fibonacci retracement, Fibonacci extension, whichever hot sweet spot zone in conjunction, okay, with the basic technical analysis, break below, retest, breakable, retest, your Fibonacci extension, your Fibonacci trading will make more sense. So you will use that breakable, retest, break below, retest, corresponding to key Fibonacci level. Now you implement a top-down trading method to trade it. That's the best approach to trade Fibonacci retracement, Fibonacci extension. The other factor that will also cause Fibonacci trader to miss a high probability trade is that they do not pay attention to the market pattern when the pullback, the retracement is outside a rising channel or a below or is outside, okay, a declining channel. So if the price is out of so the pullback, like below the rising channel, a lot of traders are waiting for a retest of the channel. But here you are buying below that channel and you are kicked down because professionals are waiting here to sell. When you are selling below the channel, you are, okay, not paying attention to the market pattern. Very simple. All right. The best Fibonacci retracement will take place in a rising or a declining channel, as I show you here, either in a rising channel or in a declining channel. And as everybody is waiting to buy or sell on the edge, you will use a top-down trading method to do exactly the same thing. All right. But remember that the price does not go up forever. All right. So sometimes the pullback. Now leave that. We will leave that one out now. Okay. The last factor that will cause Fibonacci trader to miss high probability trading setup is because they are too impatient, they are too aggressive, and they are rushing, thinking that, okay, the market will obey them, and the market will not always obey the Fibonacci traders. This is the end of this tutorial about to know why Fibonacci traders miss a high probability trades. The high probability, the simplest high probability trading setup are breakable, retested down, break below, retested down. Okay. If you have any question or suggestion, put in the comment section, and in due course, well, I will be recording another video to answer your specific question. We are the TSTW24 traders talking about know why Fibonacci traders miss a high probability trade. Happy trading to you all and speak to you soon.